she raised her final round while expecting. If anybody questioned her pregnancy and her ability to run the business, she said, I didn't want your money. I don't want your money. She successfully closed a financing, and she just did a private equity, not a private equity, but a CPG platform in Scandinavia has done a substantial transaction with her business. She's still a holder of equity in that business. So I think, we're really open to creative transactions going forward versus, the typical, IPO route.
How different would it be if the same thing started looking now like it wouldn't change if nothing else really did? Subscribe and hit this like button and share this with a friend. Hey, this is Journey with Christian D. Evans podcast. This is Christian D. Evans coming at you. I thank you so much for listening to this. We interview top-level 8- and 9-figure entrepreneurs, business owners, and CEOs that have either had an exit or they are actually running and scaling their business to that billion-dollar valuation. We've also interviewed top-level TEDx speakers as well as incredible psychologists, also a lot of wealth managers that manage $1 billion to $200 billion and more. We've had incredible guests like Sachin Kajarian, Cameron Herold, Jay Abraham, and so many others. So if you find this of value, then share this with a friend. And we really appreciate it. Guys, show our guests some love by liking this and subscribing. And guys, until next time, remember, be uncommon if you can, and enjoy the episode. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. This next guest is hell-bent on defeating the status quo, one project at a time, and replacing it with options that are more equitable, feminist, corporately, and ecologically sustainable. Revolutionary options that drive greater value for both business and consumer. She is the co-founder and the managing partner at Adventure Capital. She's also the co-founder of Feminist investment collective, The 51, and sustainable direct-to-consumer clothing brand, Shelley Kuipers. Please welcome my next guest, the one and only Shelley Kuipers. How are you doing today, Shelley?
I'm doing great, Chris. How about you?
I am doing fantastic. Well, I really appreciate you being on here. And first of all, I want to have this conversation because I think feminism and feminists, it comes across and it's got a negative or a positive connotation a lot of times. So before those that are like, oh gosh, whatever, right? I want to just clear that out and then let's build upon it, because I love to get right into a lot of your thesis and what you're doing in the investing world, in the VC world. But Shelley, help us understand your perspective on feminist and feminism.
Yeah, I totally get it, and I understand, the pushback around the word. I was actually thinking about it over the holidays, and I was like, what is it about, women, self-organizing that can be so repellent? Like, why do people get their backs up around that? I don't know. But, I think, how I look at the word, feminist or feminism is, we're just adding, we are just increasing participation of something else to 51% of the population. So, we often kind of chuckle on the venture side around, women are not a niche market. We make up 51% of the global population. And I think feminism is really just, trying to create a table and space for those opportunities that are not otherwise presented to us. I think, the US is sometimes quite different than Canada around, its social agenda, access to abortion, for example. We kind of take that for granted in Canada. But, in the context of the work that I'm doing, we've married up the word financial with feminism. And we're really looking to kind of unlock the potential of women's equitable participation financially.
So let me ask you, with your journey, and we're going to get into the VC world here, investment thesis, but with your journey, Shelley, how has feminism played a role in your life, positively, negatively, or maybe just standing up for it, or just becoming known of it and identifying that and saying, hey, this is what we stand for?
Yeah, and I think it has been a bit of a journey. I think to start with, I didn't really think about it. There's probably some naiveness about that, in the way that I just assumed I could be in whatever room I wanted to be in. And so I didn't really leverage that word or that meaning. As I was kind of going through my professional career, I would just find myself in those rooms, whether I asked for it or not. I think fast forward, I really look at, the use of that word to extend an invitation for those that wouldn't otherwise be in the room. And so really extending an inclusive invitation to participate. So I think, for myself personally, I kind of ignored the word for some time, and I understand that there's some connotations attached to that word, but I really try to use it in a positive frame. It's all upside with our participation financially, and that's really, the work and the basis of the work that I do.
So, and now let's kind of gravitate a little bit toward the VC world and, the capital markets in general. And I find this so interesting because, Shelley, you and I were seeing the right movement, the right direction. It's taking a little longer, but we do have to acknowledge what has been moved. And so what I mean by that is we have seen stats where a lot of female founders and a lot of female, VC individuals don't have access to capital as much compared to the counterparts male. So, Shelley, during your journey and evolution of, coming from the corporate to then obviously, running your own family office, et cetera, what have you seen in a positive direction that we can look back and say, okay, we are headed in the right direction. It may not be there yet, but, this is good movement. This is good direction toward the right thing.
Yeah, absolutely. I think the latest statistic that we cite right now at the 51 comes from a publication called PitchBook. You might reference it yourself. And I think that they cited that the first half of this year, 1.8% of all venture funding went to women-led companies. So it's still a very small percentage of the overall capital. But we've seen a huge increase in capital in venture over the last, 3 years. So the amount of capital that's getting allocated to women-led companies is increasing. The actual share of the pie, we're still really struggling with that percentage. I think the other advantage, or I think the other opportunity that kind of sits inside of that statistic is, we're coming off a wave of venture where, valuations, I think, were probably a little bit unreasonable. Founders were commanding valuations that were a little bit unrealistic. We're now moving into a more tempered climate that way. But I think women are at an advantage because we never really commanded the valuations that our male counterparts commanded. And so I think, we're probably going to benefit from, not being at the top of the peak of those valuations. And we probably had a more reasonable valuation. And so I would say that would be kind of the other positive thing that's come out of the, I would say the venture world over the past 2 to 3 years.
So, and correct me if I'm wrong, because it is beginning of 2010. It was very male-dominated industry, whether you're in the VC or the private equity, whatever it was. So very male-dominated. And do you feel like not only because we're seeing more women in this industry, which is a good thing, again, not as much capital is being allocated toward the women, but we are seeing in the right direction. Do you feel like with that kind of trajectory that we're going to see more women as well jump into the VC and the PE world, running their own funds, running their own firms, et cetera, that then are able to obviously advance that kind of percentage and, a little bit more equal? What are your thoughts on that?
Yeah, absolutely. So I think the stat now is 11% of partners in venture are women. Which is, it's an improving statistic for sure. And with that comes, decision-making influence, right? So if we can get more equitability around decision-making, we'll probably see a benefit of more investing decisions, to the benefit of women. And so at the 51, we always talk about, where does capital come from? How are we changing that? Who's actually making the capital allocation decisions? How do we change that? And then ultimately, we're investing in more women. So we all have our own biases. There's another great statistic, and I'll share these sources with you afterwards. But women have the same biases. They're more likely to invest in women.
That's awesome. And so let me ask you a little bit about the 51 as well as your family office. What are you guys' investment thesis? Because you do focus more heavily on the VC world. And from what we were talking offline, you're not industry specific, but you are obviously very you're agnostic in that regard, but there are certain things, criteria that you are looking for. Help us understand what you are looking for in that criteria.
Yeah, absolutely. So Adventure Capital is our family office with my husband and now our 2 adult sons, which is really cool. We started investing when they were just wee ones, and now they're involved in the family business. I love it. I would say the majority of our investing that we do at Adventure Capital is in B2B SaaS. So we're really looking for business-to-business software, highly scalable. We're looking to, have a seat at the table. We want influence and active leadership inside of that investment. So that means, we want a position on the board. That would be the majority of the investing that we've done at Adventure Capital. But one of the things that I noticed probably in 2017 was, oh, this is interesting. We actually haven't invested in any women-led companies other than the companies that I founded myself. And so that was a bit of a pivotal change for us going forward, where, then I really started to get active in the family office and allocating capital to women-led companies. And so you'll see inside of our portfolio, there are some technology-based companies that are women-led, but also some CPG companies, so some consumer packaged goods or e-commerce products that we've also invested in. So I would say largely B2B SaaS, sector agnostic, though, we like to have some relevant industry experience. We would be, kind of like early checks in, but we would want to see, demonstration of commercialization. And we would want, again, that check to have a material stake in the business. So that's on the family office side. On the 51 side, the model is very different. And so we are a venture firm and a community. To date, we've activated capital across Canada. We haven't yet embarked in our launch in the US, but we activate capital from individual accredited investors, family offices, foundations. We now have other VCs investing in us. We're raising an institutional-led fund now, targeted on food and ag tech. But all of those funds, we have 3 funds at the 51. There's 2 funds, Fund 1 and Fund 2. We call them our Feminist series funds. Those are sector agnostic funds. So we're really looking for those women-led companies and those founders that we really believe in. We believe that they have an opportunity to win in their category. And we'll write early checks. So we'll sometimes do pre-seed, seed, and Series A. But there needs to be great affinity with those companies and those founders and the community of women investors that we have. So we kind of say we have a bit of a built-in market with our investor community as consumers, as corporate leaders, as influencers around procurement. And then our Food and Ag Tech Fund is a very different fund. It's an institutional-led fund. Our community gets to invest side by side with that institutional capital, and we're looking to invest in science-based technology companies in food and ag tech.
So this is interesting. I want to loop back specifically in regards to the 51 thesis. And I like you unpacking that a little bit, because what you're basically saying is not only you come in, you want to be, first right check, but also be very, hands-on approach. Well, your thesis is slightly different because it's, obviously female founders, but like, direct, D2C or consumer brands, correct me if I'm wrong, you have a distribution established. You already have some influencers. You already have some corporate. You already have some of these individuals because of your community. That's one of the reasons why it's a very easy evolution or go-to-market strategy. Is that correct? And that's kind of the thought process.
Yeah. That's definitely, I would say, we haven't formalized it at all, but our investors, we have more than 180 across Canada today, are limited partners. In some shape or form, they represent a consumer, they're corporate leaders, they have influence on procurement. They recognize themselves as a customer of those companies. So it's very easy for our LP community to understand the investments that we're making. And the investments that we make are quite diversified. They're sector agnostic. We've invested in consumer packaged good companies like beauty brands, but we've also invested in very sophisticated, B2B platforms. So the investments have been quite diversified. We're definitely founder focused. And I would say, the business model needs to be highly defensible. There needs to be some intellectual property, whether that's, brand or, science-based, but we need to see a defensible IP strategy with the company.
And so when you're talking, founder focused, help me understand that a little bit, because obviously the female, but there's a lot that goes into personality, characteristics, et cetera, et cetera. What do you look for? Do you look for someone that maybe had a recent exit that also, because obviously that, advances the chances of them, succeeding in that next company? Or are you more of like, hey, well, there's other kind of criteria or attributes that I'm looking for outside of the business concept or the proof of concept?
Yeah. I think there are characteristics that are really important. One that we cite often is, there's so many now. And again, when we think about the year ahead for us as a founder or business owner, right? It's going to be interesting. So, but I think the characteristics that we look for, one of the most important ones would be coachability. So are we investing in a founder that really seeks to surround themselves with people that are maybe more talented or smarter than themselves? Or do they always have to be the smartest person in the room? Do they have the courage to say, this is what I'm really good at, this is what I'm not really good at, and therefore I have to hire a high-performing team around me to execute on the vision that I have? That would be, I would say, kind of like the number one assessment of the founders that we invest in. I think judgment is another huge one. And, you probably know, judgment isn't something that you can teach. It's probably pretty intrinsic inside of that person, and how they approach their business and how do they build their business and build their team and design their vision. So those would just be, a couple that I would cite.
You also, because when you're at that pre-seed or pre-rev, a lot of times they don't have the team established yet. Maybe they have a founder, maybe they have maybe a co-founder as well, or maybe they may have one or two or so. It just depends upon what their friends and family kind of raise. But do you, looking at that in the team structure, because it's more that Series A is where you get that team a little bit, but help me understand the way, Shelley, you look at that in more of a team structure, the culture, things like that, that says, okay, this is a green flag, this is a red flag, this is a yellow flag, we can work on that, but there are certain things that are like non-negotiable for you.
Yeah, I think it's a great question. I think, again, pre-seed, you're investing in the founder again, right? So, do they have the ability to build a culture, from, team member one? The other thing that I would say is important in pre-seed is, being married to the problem, but maybe not being married to the solution. So having the tenacity and the resilience and the wherewithal to really navigate and pivot accordingly, right? So, every founder has identified a problem. That's first solution that they take out to market might not generate, might not find product market fit. And so how are they learning to pivot to find that ultimate solution that does demonstrate commercialization and have the opportunity to scale? I think, that's what you're really investing in. You're investing in the founder's ability to do that journey. So that would be, kind of how I would summarize that.
See, this is why I find this so interesting, because, when I look at, the VC, and I've had these conversations with individuals, I do not personally invest into that VC ecosystem, but I do understand when you're pre-seed, pre-rev, you're kind of risking a lot. But when you're at that Series A, you got some momentum. You still got a risk, but the momentum is working on your favor. So Shelley, with you, when you're deploying capital, is it more of smaller checks but quantity plays, knowing kind of you're working the numbers, or is it more of larger checks and saying, hey, we're going to work with this, and we're just more strict on our due diligence or our process, and making sure that when we are picking winners, we really go deep into each one of these? What does that look like? What's that thought process?
Yeah. I think we're probably seeing, our first fund one. I would say we invested in more companies across the spectrum of pre-seed and seed, and really trying to be that catalyst that would help them get to Series A. I think with our fund two, we're going to try a slightly different strategy. Well, we are where we plan to invest in fewer companies and go deeper in with those companies. And so that really means, following them along that spectrum of pre-seed, seed, Series A, and beyond. It was interesting because, we were kind of discussing as a team, we were thinking, maybe seed is our sweet spot. Maybe we need to see that demonstration of commercialization before we, invest. But some of our best performing companies have been those pre-seed companies, right? And again, if we look back on that, what was the defining factor of that? Again, I would do a line right back to the founder in every case.
And that's so interesting because, I've got so much. You're really betting on the founder. You're betting on the jockey, right? Which is what everybody's always talking about instead of the horse itself. And so having that conversation, that dialogue, and that's why I think it's so interesting because, that's why I appreciate you explaining a little bit about what you look for in regards to that personality, that behavior, what that looks like. What do they have the it factor to be able to go through the scale of this?
Yeah.
Now let's kind of pivot a little bit further. I know a lot of times, depending upon your thesis, it's normally a 5 to 7, 8 year kind of stint where you're in it. Do you negotiate the deal where it's like, hey, to get some chips off the table, say, hey, I'm going to write a check, but I want a percentage of the sales until you hit my amount that I've invested, to get some chips off the table to mitigate that risk? Or is it more of like you just structure it's like, hey, I'm going to write a check, you're going to own some equity, and we're going to work together, and we're going to help you, structure that? How do you get? Is it contextual? Is it just deal to deal? It just depends upon what that looks like.
No, we would always do an equity deal. So, and typically it would be, pref shares, but we wouldn't ever do a rev share. So, the types of funds that we have stood up, they're long-term investments, right? So it's a 10-year fund. So you're investing in our fund. We are then investing in ventures. And obviously we hope that there are transactions in the life of that fund and distributions are going back to our LPs. But yeah, we're always equity-based investors.
Okay, I was just curious because some people I've heard they negotiate differently.
Yeah,
And,
absolutely,
now,
absolutely.
when you're looking during that journey 5 to 7 years out, are there certain checkpoints that you like to see them hit, right? Because we all understand the VC world, there is about a third that will just they won't be able to make it, but there's a third that obviously you hit that unicorn, and there's a third that you'll be able to still make a nice margin off of. So what that looks like is, are there certain, inside Shelley's head, because you've been in this marketplace for many times, are there certain things consciously or things that you are aware of, like, hey, we want to hit this metric or KPI or something in this time frame? Because if we're not on that, then we're not on the right road, and there's something that's going on, and we need to address that. And what does that look like? What are those checkpoints or those tiered out?
Absolutely. I mean, we do portfolio construction, so it's kind of like a pro forma around the portfolio that we want to construct with the fund. So we go through that process, we design it. We obviously are making some assumptions about how many ventures will be successful, how many will not, to generate the return that we are, indicating to our investors from the onset, right? So when we go out and raise capital, we're saying, here's our fund thesis. This is what we're investing in. This is the expected, return on investment back to our LPs. This is the time period in which we would like to do that. And here's the portfolio construction to do that. So it's definitely a strategy that's well thought out. But again, it's a very high risk asset class. So, I would really encourage everyone to go, okay, well, what portion of my portfolio should be going into this asset class? And it should be, a small portion of your portfolio.
I've talked to some people, and I know Canada is not getting hit as hard as the US, but I think it's going to be a little bit worldwide, or it's going to be trickled down a little bit with the economy. Things are kind of tightening up, et cetera, which has a trickle down effect. I've heard some people, the VCs, where they're telling their portfolio companies to have a runway of until 2025 or late 2024. What are your suggestions? I know it's very contextual, but what are you kind of saying to your portfolio companies to say, hey, we've got enough dry powder to ensure that we're able to, withstand whatever comes at us? What does that look like?
Yeah, absolutely. We're offering the same advice. So we're either on the board or we have advisors on the board or somebody in our community is on the board. And, I'd say the advice has been consistent, like batten down the hatches, like we're going for a ride for the next, 4 to 8 quarters. And so trim all costs where possible, create as much runway as possible. If you can do any kind of like top up on your financing right now, do that, right? If you have that trusted investor network right now that wants to go, yeah, I'm willing to, invest in a bridge round to kind of, improve the coffers of the business, then do that. And so, not every one of our companies in our portfolio is in a position to do that, but that's definitely our advice. So yeah, we must listen to some of the same podcasts because, that's definitely our theme too.
That's awesome. That's awesome. Now, when you're looking this out, and I'm always intrigued with this structure, is because, and I want to get your opinion on this, Shelley, because when you're seeing a lot of capital in the markets right now, I've noticed a lot of them, they're not some of these companies that are scaling, like the Uber, for example, and that's just one example. They got to unicorn status, $1 billion valuation and more, but they were not positive EBITDA. And so, Shelley, when you're looking at, potentially exiting at some point during that scale, do you like to see a healthy company where it's like, okay, there are certain margins, there are certain churn rate, there are certain burn rate there I want to see, otherwise we're headed the wrong direction. Let's talk a little bit about that.
Absolutely. So again, that's what I would say is, we've seen this pendulum, right? And it always goes back and forth, right? We get unrealistic valuations, anybody can get funded, the business fundamentals aren't there, all the way to, scorched earth or whatever we want to call it. But, the pendulum has to kind of fall back in the middle somewhere. And we just have to focus back on the business fundamentals, right? So, and maybe it doesn't mean growth at all costs, right? There's very few companies that can be, an Uber company. And I think, we just need to be realistic about that. And, how many of the companies can achieve that scalability versus, building a company that has a business fundamentals around growth rates, around churn, around the business model, really building a sustainable business model and, charting towards profitability on I would say, on a much improved basis versus, some of the business models that we've seen, right? So, yeah, I think there's going to be some tragedy in the quarters to come because, growth at all costs has really been the model in venture. So I really hope to see venture go through a bit of a renaissance back to, building really good businesses that return capital to our shareholders, where our founders thrive as business leaders. They're not burning out and they're not being, held up as like some idolic figures that are just not sustainable, right?
Well, I appreciate you bringing this up because I was talking to Sachin, which was one of the managing partner at Apollo, and he was explaining a little bit about the structure and the incentive. Is like you mentioned, it's focused on the rate of return, the IRR, so much so that it's the detriment of the fundamentals sometimes. Because yes, they grew that, they had amazing, fun, that return, whatever, cool, but also what's the end result of that company? Well, like I've noticed in the private equity where they're doing a lot of leverage buyouts, they're just stacking up a whole bunch of debt on some of these companies. And it's like, cool, we got that return, but to what cost? So it's you got to really look at it. And Shelley, let's kind of dive into this a little bit further. What are certain things that you like to look at? Is there like a specific margin? And I know it's contextual, right? It's depending upon each company and what on, but I know like B2B, SaaS, let's take that for example.
Yeah.
They've got a pretty decent margin. And definitely if you go to market and you hit that, mass scale, you've got some pretty decent income in ARR. What are certain things that you like to look at and say, okay, hey, we're hitting this margin. Obviously, with talent acquisition, it's going to decrease it as we build the infrastructure out. But at some point, you hit a nice, consistent, margin as well as a consistent ARR as well. So, what are certain things in that context that you like to look at?
No, I think that's good. Have you heard of the rule of 40?
I don't think so.
Yeah, it's
Explain
a
it.
good one. I'll send it to you afterwards. That would be just like a good overall metric to look at around how do you measure, I would say, business fundamentals inside of the company. And I can walk through more of it. But I want to go back to the other point around the fundamentals of venture. Right now, the model is set up in such a way that all venture firms are really motivated by getting to that next stage of financing to claim an improvement on the valuation, right? And sometimes those that as an incentive can be misleading, again, around the business fundamentals. So if we get the next stage financing at a certain valuation, does that really indicate that the business fundamentals inside of that organization are strong? I don't know. But there is, I would say, a motivation and an incentive inside of the venture world right now to go, well, I've got 3 up rounds and therefore my fund is performing well. But if we really take a look, underneath that and peel that back and look at the business fundamentals of those businesses, do they really have that valuation from a business fundamental standpoint? I think those are the questions that we need to be asking.
Well, see, and that's why I think it's so important because, see, I know a lot of our listeners, maybe they are taking distributions from their first company, maybe they've had an exit. And like myself, you've got all this, cash flow and you don't know exactly how to do it. And you learn from mistakes, but that's my whole goal is to, have people like yourself, Shelley, that has been able to deploy capital, had some ups and downs, but also be able to learn from that and then obviously mitigate that loss and have these strategies. So I appreciate you explaining that and the way to think about it and asking the right questions and thinking about, okay, this is what you should be looking at. I really appreciate this. Now, Shelley, when you're looking at an exit, I know there's a lot of different strategies, and I know again that timeline is like 5 to 7. What does this look like in regards to, what you like to preferably see as an exit? Do you like an acquisition? Do you like an IPO? Do you like a SPAC? What do you recommend, or what do you like to see?
Yeah, you know what? Again, I just think the climate in the industry is changing, right? So, we're seeing late stage companies like maybe the companies that would be pre-IPO, their valuations have been hit tremendously, right? So, in some ways, I'm glad that we're doing early stage investing. We're pre-seed, seed, Series A, so the valuations can stay, relatively tempered. But from a transaction standpoint, I think, we'll be opportunistic along that continuum, right? If there's a strategic buyout by private equity that's really paying for the strategic value of that business, as well as, the opportunity in that business, that's great. Any other type of transaction would be really attractive to us as long as we're demonstrating a return to our investors. So I don't think we're necessarily married to the type of transaction, but what we are married to is getting that transaction so that we can return distributions back to our LP holders. And that's really built inside of our fund model, is that, once a transaction happens, we do those LP distributions. And so, it's not our plan to recycle those distributions, but it's our plan to pay them out to the LP. So again, I wouldn't say that we're married to any type of transaction just yet. And I would also say that, again, we're building companies that may not otherwise be invested in. So if we think about women building beauty brands, this is a fairly new thing. Largely, beauty brands historically have not been built by women. So we've seen lots of women build out these beauty brands, and they are being acquired by different companies. I don't know if you know the story of the NYX founder here in Canada. Her story is great. She raised her final round while expecting. If anybody questioned her pregnancy and her ability to run the business, she said, "I didn't want your money. I don't want your money." She successfully closed a financing, and she just did a private equity, not a private equity, but a CPG platform in Scandinavia has done a substantial transaction with her business. She's still a holder of equity in that business. So I think, we're really open to creative transactions going forward versus, the typical, IPO route. Plus, I think IPOs are just going to be quiet for a while, right? So.
Well, that's what I was wondering, because I'm seeing a trajectory where there's not as many IPOing, and that was maybe just within the last few years. But I mean, I think that's going to continue because there is being more accessible, allocation. I know, like the SEC guidelines, they're restructuring what a credit investor is, which means, if done correctly, they can obviously, that's going to be more capital for 85% of Americans that they can deploy in alternative investing. And then Jobs Act, of course, a few years back, that helped kind of facilitate the restructure of where this is going, and we've seen a lot of money flowing. And then, of course, we just have a lot of stuff going on. I think it's always interesting to see when money is more decentralized, and I think that's a really good example. Now, Shelley, I want to ask, because you're kind of gravitating away from the IPO. There's other ways, strategic approaches, to kind of align with your thesis and making sure there's a good transaction. Do you? Because a lot of times it's really dependent. But I wanted to get your perspective. When you're looking at getting an exit, do you like to take some of it and say, hey, you know what? I want, if we have 10% equity of this company, it's scaled to 100 million, whatever, and it's going to get acquired. Cool, wonderful. Do you say, okay, I want to take 5% cash out and then take 5% and keep that equity and let it run? Or what does that look like? Because obviously there's still that upside, that potential upside. You don't want to miss that, but also you want to get some of your chips off the table.
Yeah, totally. And again, what I would say is, depending on the trajectory of the business, either of those options could be available. So if I look at, some of the transactions that we've done with our family office, we've done both, right? We've done, all cash deals. We've transacted, a portion of the company to private equity, had the opportunity to take something off the table, but kept equity in the business. And guess what? It transacted again. There was more upside in that next transaction. So I think, again, it's really going to be venture specific. Again, what is the trajectory of that company, and how valuable is it to other stakeholders? There's a transaction because we need to dispose of this business versus, there's a transaction because this company is only going to keep growing. And so I think being opportunistic about those transactions is something that we have to keep in mind at the 51, and we definitely have at Adventure.
So what does that look like a little bit further? Okay, and what I mean by this is, like, okay, there's that growth, and what are you looking for? Is that like this IPO company buys this, acquires your company, cool, and now there's still like a massive market penetration, you see trajectory, and then as well as you talk to the leadership team of the private equity or that company that's acquiring, or do you also want to take a leadership position or a board to make sure that you still have some say in that company and where it's directed? What does that look like in regards to how you structure to ensure that, okay, hey, it definitely, if you're still taking some equity and you still got some chips on the table, if you will?
Yeah, I mean, again, I think, what happens as you do those transactions over time, the percentage of your equity is going down. So you might not have the same seat at the table going forward that you did previously, but that's okay, because your investment might actually be in better hands with other people going forward than it was with you at the stage that you invested in. And so I guess that would probably just beg another comment around, invest in the stages that right? And, be really disciplined about your investing. I know for ourselves at our family office, when we've invested in things that have maybe been a little bit more outside of the spectrum of our investing experience, it hasn't always paid off. It hasn't always paid off very well. And so again, I would encourage everyone to come up with their own investing thesis and really stick to it. Or prove or disprove out those assumptions to get to your investing thesis. So invest in what right? I think Warren Buffett has proved that over and over again, right?
Yeah, it's a good point, but sometimes we always love that shiny object syndrome, right? That little thing over there.
Yeah, totally, right, totally. But then I would just say then that's probably gambling, right? So are you gambling or are you investing?
And there is a difference, right? There is a difference.
Totally. And we've all probably have done both. So
you know it. There's numerous times where it's like, oh yeah, I love the energy, charisma of this person, and here's exactly. X amount of dollars.
And that did not work out, right? Yeah, exactly.
So speaking of loss a little bit, I was talking to someone and I found this very interesting because in the context of entrepreneurship and the self-improvement world, we're always talking about, persevere and never stop, never quit, right? And in the investing world, it's slightly different, right? It's unorthodox a little bit. And what I mean by this is sometimes there are a point where, okay, you have to look at, contextually and keep your bias out of it. You may like the founder, you may like the idea, you may like this, but also it hasn't, you've been in this for a period of time. You wrote some money, you haven't seen anything produce. At what point do you say, okay, you know what, I'm going to walk away? Or, maybe still leverage some of your ecosystem and say, hey, I'm not going to write a check, but I will give you access to other people. If you could raise some money, I will come in again. Like, what does that conversation look like, as well as what kind of says, okay, like a hard stop or a red stop to ensure that, okay, we're not diverting our attention, our resources, and our time towards something that will not produce results, because you want to make sure you're obviously focusing on the things that will produce results. And that's really the name of the game.
Mute. So yeah, you don't want to do a bridge to nowhere, right? Because you're just extending the agony of the process out even longer, right? So I think again, it goes back to, the founder. Does the founder have the ability to get through that phase of the business that's going to be extremely challenging, right? So, they're not able to get a lead investor on the next round. They haven't been able to properly demonstrate commercialization in the market. They haven't been able to effectively lead and captivate the market to their opportunity or to their solution, right? So, there's only so many things that they're not checking off. Well, there's, you're going through that list and, they're not checking them off, but, more runway is needed. You just have to be, really judicious about that decision, right? And so, yeah, absolutely. You go, well, I don't want a failed investment, or, I've always really admired that person, but they haven't been able to execute. So you've got to be judicious in your decision making in that next stage, and it's really tough, right? I've been a founder, successfully and unsuccessfully in the past, and it's a brutal experience and a brutal process to go through. So, but at some point, there are some founders and some ventures that you just won't continue to invest in, and you have to walk away. And it's hard for the investor, and it's brutal on the founder and the entrepreneur.
Well, why I think it's so important, I appreciate you saying this, because I know human psychology and human behavior gets in the way, right? And we've studied this. In fact, I've had some people on that talk about investing. When you invest into a company, whether it's on the IPO, right, whether it's in the stock market, you tend to be more like, just biasly, you tend to be like, okay, hey, I want this company to go, up. And I was talking to a wealth manager, and it's interesting because it's like, sometimes we double down on a position when we see the stock market going down, or that specific stock going down. We tend to say, okay, well, I'm going to dollar cost average and double down and put more money into it. And the reality is sometimes you have to just take the loss, and then it goes down another 10 points. That's okay, but then get back in at a different point, right? And so that's why I was just curious, like, what are some hard stops or some like boundaries that you put in play and say, okay, hey, we've been at this company, they haven't successfully raised a Series A. They haven't gone to commercialization, like you mentioned, go to market. And there are certain red flags. And at this point, we're going to have to pull the plug. We'll still be there. I'll still be an email away, but still say, hey, these are the things that need to happen in order for me to come back to the table. So, what does that look like a little bit? Are there certain, like, okay, hey, just like kind of what I mentioned, or is it more of like, hey, if you're not successfully, raise a Series A, or
like I would just go back to, again, like, if you haven't been able to demonstrate commercialization, and therefore you can't now activate the investor community around, the next raise of capital. So we all need this capital to extend our runway to prove out the assumptions of the business. But if you can't do that kind of like that basic one, which means, I can commercialize my business either through my human capital, right? Like my ability to sell to that company a strategy around what they need to do, or the technology that I'm selling. Like if you can't sell that and you can't commercialize that, I just think, you're going to be in a really tough place, because if you can't get customers to buy what you're selling, you probably can't get investors to buy what you're selling, and you probably can't, sell teammates to join your team through a really rough time to keep going. So I think so much of a founder and an entrepreneur's journey in building a company is their ability to sell and to captivate and inspire, to create that momentum. So yeah, it's brutal. And if they can't do those things, you have to walk away.
It's a tough conversation though, but I
It's a tough
appreciate you sharing that.
conversation. Yeah,
Yeah.
absolutely. Yeah.
What about when I think there's been a lot of conversation about mental health, right? And that's in the corporate world or just entrepreneurship itself, right? And I think we all can come to the agreement that there needs to be some sort of balance of some sort, right? It doesn't need to be like 40 hours, because obviously you're not able to build a sustainable business unless you're pushing a little bit 60, 70 sometime a week, or even more, right? To really just get it off the ground. So when you're looking at that, obviously you would still want mental healthness, because it's not a sprint, it's a marathon, right? Building that. So what do you like to see to ensure that they are not just focusing on the business, but long term that they're in it for, like, hey, okay, what are certain things that you're doing externally? Are you working out? Are you eating healthy? Are you doing certain things that say, okay, hey, this person I know has the energy to be able to withstand all the ups and downs of this in the future?
Yeah, it's kind of like that whole idea, like if you don't look after yourselves, you can't look after anything else, right? So, your ability to be, fit in body and mind, and have that resiliency to build a company, I think is super important. And I think it all adds up together. It's all a package together. You can't have one without the other. You can't work at an extraordinary pace without looking after yourself. And so you have to figure out what that recipe is for yourself, right? So is it meditation? Is it exercise? Is it, watching, the food that you're taking into your body? Is it, surrounding yourself with mentors and champions? Is it, really being honest with yourself about what you're good at and what your superpower is? And again, surrounding yourself with others that have different superpowers. Like, I just think it's a whole thing that you need to look at. And, the culture that you're building, in your company. So, yeah, I think in order for you to, actually, there's this book that was just recommended to me. Now I can't remember the name of it, but it's like, there are some defining factors around being successful as a founder and entrepreneur. And I think at the center of it is, looking after yourself. You've got to be the strongest person you can be throughout this. The fittest, the
Yeah.
smartest, the strongest. You just have to have such, resiliency. But I do think it's good as the industry does talk about this now, right? Does talk about, the mental fatigue and for founders, right? Because it is brutal. And I can speak from my own experience. It's like, it's demoralizing. And you really have to kind of rebuild your, you have to rebuild yourself in that situation if you weren't successful. So
Yeah, it's fun to see this, because I've seen a lot of VCs, just as they have marketing and operations and talent acquisition for their portfolio, very similar to almost like therapy or like mental health, just kind of access, so that they can kind of release and do whatever they need to do, talk through whatever they're going through, and sometimes that's the best. So I've seen kind of a trajectory or kind of a trend that direction, with more VCs adding that onto their kind of repertoire of services that they add to their portfolio, which is awesome. Shelley, I really appreciate you being on here. And I love that you're kind of talking about the feminist side of things, but also just your thesis, right? Being able to find, and what I've noticed is your founder focus, right? Really understanding that founder, understanding that journey, really being there and being the first check, but also walking through in it to win it all the way and helping them out. And, for those that want to reach out to what you're doing there at the 51, as well as Adventure Capital, how does my audience reach out and connect with you, Shelley?
Yeah, I mean, you can reach me on, you can reach out to me on Twitter. I'm on LinkedIn. Yes, I'm still on Twitter. I'm actually really enjoying it right now. It's outrageous. But you can reach out to me by email as well, Shelley@51.com. It's kind of like my main inbox right now. But yeah, just reach out to me if you're a founder looking for funding in kind of like that pre-seed, seed, Series A. We definitely would be interested in meeting with you. And if we're not a fit, we can always introduce you to others. And if you are an investor right now, limited to Canada, but if you're an investor looking to invest in this asset class, specifically in women, drop me a note. Love to hear from you. So thank you.
Awesome. And guys, those links are in the description below. So make sure you stop what you're doing. She's got tons of resources. She's got a blog as well. And Shelley, I really appreciate you being accessible where you put your email down there. So I'll put that email so you guys can respond and connect with her. Shelley, again, I love what you're doing out there and being on the forefront and, being able to raise, fund 1, fund 2, and now to the next and getting to the US market as well. I always love to ask my guests before I let you go, is there any last words of wisdom that you'd like to share with our audience?
Yeah, but I didn't prepare for that question. That's a good one. I think I would really encourage women to get involved. We just find that, we don't have to just invite once, we have to invite like second time or third time. Women need to take control of their, kind of their financial destiny. And I think, investing is just one opportunity in that journey. So I just say, have the confidence and the courage to leap into this asset class and start investing in women. So, yeah.
Well said. Well said. Guys, that is the managing partner of Adventure Capital, as well as co-founder of the 51, my friend, Shelley Kuipers. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.
Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.